Dustin here, financial advisor with Jazz Wealth. Let's talk today about ETFs. How do they work? What are they? Should we even be interested in them? All right, so ETFs are also called exchange traded funds, and basically here's how it works. If you buy a stock, say Apple, for instance, then you're buying into Apple. Basically, whatever people think is good or bad about Apple will cause the stock price to go up or down. You're basically putting all your eggs in one basket, right? Because if Apple has a bad quarter, if Apple announces bad news, if Apple just goes out of business, you don't think that's going to happen, but essentially anything bad that happens to Apple would directly affect you. Well, an ETF is basically like buying a basket of stocks, where you can buy one product, make one transaction, and have access to all kinds of different products. So let's take the example of the S&P 500. If you wanted to buy the entire S&P 500, you couldn't. So you look at the S&P, and the SPY is the stock symbol. That is the original ETF. I'm not playing favorites. That's just the first one that ever came out. And basically, if you buy one share of the SPY, it's like you own shares of Amazon, Microsoft, Facebook, all kinds of names, really. 500 names in the S&P 500. Now, the current price of the SPY is currently $268. So for $268, you could participate in 500 different stocks. Now, that's how it works, right? If the S&P goes up a certain percentage, then the SPY will go up the same amount as that. Well, not really, because, see, exchange-traded funds have fees. They get paid just like mutual funds do. Now, I get a lot of phone calls from people that say, there are no fees in mutual funds, Dustin, or mine are free. They don't charge me anything. I encourage you to look a little deeper. I guarantee you, you're paying something to own that mutual fund. Well, exchange-traded funds are the same way, except they're really easy to understand what the fees are, and you don't actually pay the fees directly out of your account. Here's how this works. If you look up SPY expense ratio, that's the fee, the expense ratio. Now, on the SPY, they charge 0.09% a year. Now, what happens is they slowly take that amount out throughout the year from the price of the ETF. They never reach into your account and take the money out. You don't pay it, you don't write them a check or anything. It just slowly comes out of the price. So basically, if the S&P was flat for the year, it did not go up or it did not go down, you would still lose 0.09% out of your account, and that would be the fees. So if you invested $10,000 and the S&P 500 was 0% gain or loss for the year, then you would have $9,991 in your account at the end of the year. You can see very quickly if the S&P 500 goes up 10%, well, you're almost going to get that 10%. You're going to get 9.91%. The rest of it will slowly be taken out over the course of the year for their expense ratio. So you can see the expenses are actually quite low. It's not the cheapest ETF to participate in the S&P 500, by the way, but it's the most liquid, it's the original, and the fees are really, really small. So it's really not that big of a deal if you choose that one to invest in. So why do we choose ETFs to manage our clients' portfolios rather than mutual funds or other products? Well, one of the main reasons is transparency. I can very clearly see what it's going to cost throughout the year and weigh that against the probability of any kind of success. As we build portfolios, we focus on your actual goals. So an exchange-traded fund allows us to diversify while understanding exactly what it's going to cost you. And like I said, they basically cost nothing, so it's very, very cheap. Whereas mutual funds have 12b-1 fees, redemption fees, front-load fees, back fees, administrative fees, transactional fees. Look at the costs of the mutual fund. Don't just look at one thing like the 12b-1 fee that they tell you to focus on. Look at everything else, see what it's really costing you, not to mention the bid and the offer price. I won't get into that. So basically, if you're interested in any ETF, or you're looking at your account here with Jazz Wealth and you see ETFs in there, then you can just look up and see whatever the symbol is, SPY expense ratio, or just click inside of your account and you'll actually see exactly what it costs. We don't buy any high-fee ETFs, and there really aren't that many anyways, so there's a lot of really, really inexpensive ones to focus on. One of the other great reasons to use exchange-traded funds is liquidity. You can trade them throughout the day at any moment in time. You can even trade them after the market closes and before the market opens in the morning. Well, mutual funds, you have to wait till the very end of the day, then they tell you the price, then you can decide if you want to buy or sell it. It's not really that transparent, and it's certainly not liquid if you only get one shot to buy or sell it throughout the day. Not that you need liquidity in a retirement account so much, but hey, you never know. If you want to make that transaction and you don't know what price you're going to get, that's pretty tough with a mutual fund, whereas an exchange-traded fund, you can pull it up on your phone, see the second-by-second price, and make a decision from there. Finally, we'll talk about risk. I get a lot of questions about exchange-traded funds and how risky they may be. Let's just put this in plain English once and for all. A mutual fund, an exchange-traded fund, Bitcoin, gold, the US dollar, all of these investments are not risky. The investor is who decides the risk. So take Bitcoin, for example. Everybody's saying, oh my God, it's so risky, who knows what's going to happen. It's only risky if you're betting more than you really should. It's only risky if you buy a lot more than you can financially handle. So an exchange-traded fund is only as risky as you make it. Any investment product on the planet is only as risky as you make it. So whoever says exchange-traded funds are more risky than mutual funds simply doesn't get how they work, right? You don't have to buy 1,000 ETFs for every one mutual fund. You can buy one. Or better yet, at Jazz Wealth, you could buy a fraction of an ETF. You can't do that anywhere else. So the risk thing is all up to you, or the guy that's managing your account has nothing to do with the product. All right, leave me a note in the comments section. Do you think exchange-traded funds are the right fit for you in your retirement account, or do you have exchange-traded funds in your account, and how are you using them? I don't want to see that you're just guessing and picking an ETF because someone told you. Tell me how you've balanced them out to make sure that you participate in some performance of the market's gains. Not sure what that means? Go to jazzwealth.com, click Chat with Jazz, or if you need help managing those retirement investments, just want someone to do it for you, go to jazzwealth.com, click Invest Now. So many of you have done that. I am so grateful. Thank you, by the way. And we'll be glad to help you out, and I hope to talk to you soon.
Take it, Snatch.